Assalamualaikum and a very good day. We are from group Starlight. I am Siti Yusnizah and my group members is Patin Hazwani, Sahida, Jasmine Arisa Iman, Nur Farhana Aswani and Fatin Arifah Shera. Today we are going to present about requirement 1, which is differentiate between accounting cycle and operating cycle for the story of Patin to fulfill the requirement EPPA 471C. Based on our presentation, we will explain about definition of accounting and operating cycle, the differences, and the last one is comparison with other economic activity. So, let's start.
Okay, first I will present about the accounting cycle. The accounting cycle is the holistic process of recording and processing of financial transaction of a company from when the transaction occurs to its representation on the financial statements to closing the accounts. One of the main duties of a bookkeeper is to keep track of the full accounting cycle from start to finish. The cycle repeats itself every fiscal year as long as a company remains in business. The accounting cycle is often described as a process that includes the following steps. There are 9 steps, which is first is identifying, collecting, and analyzing document and transaction. Second, recording the transaction in journals. Third, posting the journalized amounts to accounts in the journal and subsidiary ledger. Fourth, preparing an unadjusted trial balance and perhaps preparing a worksheet. Fifth, determine and recording adjusting entries. 6. Preparing and adjust trial balance. 7. Preparing the financial statement. 8. Recording and posting closing entries. 9. Preparing a post-closing trial balance.
Hi and Assalamualaikum. My name is Jasmine Arisa Iman. I will present about operating cycle. Operating cycle refers to number of days a company takes in converting its inventories to cash. Or more detailed, it refers to the day required for a business to receive inventory, sell the inventory, and collect cash from the sale of the inventory. This cycle plays a major role in determining the efficiency of a business. The formula of operating cycle is inventory period plus account receivable period. Inventory period is the amount of the time inventory sits in the storage until it gets sold. And account receivable period is the time it takes to collect cash from the sale of the inventory. There are 5 processes of operating cycle. First process is raw material procurement. This process where the company will purchase fish, seed, or baby patin fish. The second is work in progress. At this process, the company will harvest patin fish until they reach their maturity. The third process is finished goods. This is process where the fish is ready for sale. And the fourth process is receivable. This is where the company will sell the patin fish to the customer. And the last process is cash. This is process where the company will receive a cash from the customer and earn profit for the inventories that have sold.
Hi, I'm Saida. I will be explaining about the first 2 points of differences between accounting cycle and operating cycle, which are length of time and focus. The first point will be length of time. For accounting cycle, all the information or transaction occur during accounting period will be recorded, as the account period could be recorded as monthly, quarterly, or yearly depending on the size of the business, whether the business has a small business or a large business, as Patin recorded their account as yearly. Whereas for operating cycle, it will be monitored based on their inventory, where the inventory takes place from the moment the inventory was obtained until it was sold, as Patin recorded their inventory every 6 months. Move on to the second point, which is focus. For accounting cycle, it has bigger view within the business, where it covers all transaction or activity occurs in the business, because all activities will be recorded in order to generate their financial statement. While for operating cycle, it only has small focus in the business, which is the inventory, where it only focuses on the movement of the inventory or the product itself.
My name is Farhana Aswani. Now I will explain another 2 differences, accounting cycle and operating cycle. The third point is valuation. There are different methods in valuation in the accounting cycle and operating cycle. For the accounting cycle, it values all the financial transactions and analysis that involved in a business. This includes all the costs of operating cycle and also the costs that incurred during the accounting cycle, such as management costs and transportation costs. while operating cycle is value the expenses and profit based on inventory for the business operation. This cycle value directly the net profit based on sales and costs incurred during the period of operating cycle. By referring to the case, for each operating cycle, Shah can evaluate the net profit of the party fish sale is less to the cost, such as fish seed, pellets, and salaries that incurred during the operation. The fourth point is number of steps. In the accounting cycle, there are 9 main steps, starting with the identify business event that need to be recorded by looking at the financial transaction that occur, such as selling inventories or buying raw materials. Then do journal and posting, post to the ledger account, run trial balance, adjusting entries when necessary, adjusted trial balance, prepare financial statement, close account, and post-closing trial balance. While operating cycle contains 5 steps: raw material procurement, work in progress, finished good, receivable, and
My
cash.
name is Siti Yusriza. I will continue the presentation about comparison with other economic activities which is service industry. Service industry is an economic segment that provides certain intangible activities that fulfill needs to their customers. For example, transportation, education, and telecommunication service. Service industry also produce more than 70% of the job and the largest part of country's gross domestic product, which is 56.7%, compared to agriculture industry 7.3% in 2018. The customization for service are often customized to satisfy the specific needs of customer. It shows that service industry it depends on satisfaction of customer. If the customer satisfied, the business will grow. Service industry often have simple financial transactions that involve taking customer deposit, billing client after service provided, provide the service, and the last one is process the payment. The income statement format for service industry is simple because there is no inventory. It shows the operating cycle for service industry, which is start from cash available, cash paid for employee work or provide service to the customer, service sold to customer or account receivable, and the last one is customer pay for service, which is revenue or sale. An operating cycle is the amount of time it takes a company to use or rolling the cash. In conclusion, the more faster completing the cycle, the more stable financial position.
Hi and Assalamualaikum. My name is Patin Shera, and now I'm going to present about comparison with other economic activity, which is manufacturing industries. A manufacturing business is any business that involves in the process of transforming raw materials, parts or components into finished goods. Manufacturing commonly employs and machine setup with division of labor in a large-scale production. Such finished goods may be sold to other manufacturers for the production of other more complex products, such as aircraft, household appliances, furniture, sports equipment, or automobiles. Or it also distributed via the tertiary industry to end users and consumers, usually through wholesalers, who in turn sell to retailers and then who sells them to individual customers. Next, let's go through operating cycle for manufacturing industry. As you can see in this diagram, this is the cycle for manufacturing industry. So how do manufacturing organization operate? So first, they induct the cash into the business, taking a loan from bank or by their own contribution and so on. With the cash they have, they purchase raw material stocks. Then raw material convert into work in progress. So raw material placed in production process into machine and it is work in progress. Once the processing is finished, that raw materials becomes the finished goods. And then after that, the finished goods are sold. It either sold for cash or credit. If the finished goods are directly sold by cash, it will directly become a cash. But if they're not sold by cash, they're sold by credit sales that create account receivable for collection. Once it realized, it becomes a cash. So that is operating cycle of manufacturing industry. Basically, we start with the cash and we also come back with the cash.